money supply increasing from 3.8 to $5 trillion recently, with the debt being at $23 trillion, and with about 2/3 of what we've done so far in the $3 trillion relief package looks like goes to debt, and with the potential for more movement by the Fed that would take the balance sheet now from $4 trillion just in March. The 5 moves you made takes it up to potentially $13.5 trillion. It's around probably $7 trillion today. And it could go north of 14 if, in fact, the Main Street program is fully levered up. Help us understand, I mean, how do you put this genie back in the bottle? Help us understand how you're thinking about this demand on capital, demand for capital, and what it might do to interest rates in the short term and the long-term implications of what we've just done. This is not a criticism at all. It's just, I'd love to get your thoughts of how we should be thinking about that balance sheet, given that China, Japan, EU, all the other big central banks are doing fairly similar moves, just not as dramatically as we have done.
So when we expand our balance sheet, when we buy securities, as you know, Senator, so we bought a lot of Treasury and MBS securities to get those markets working. As these facilities grow, we'll also expand our balance sheet, and those also, that expands the money supply. I would expect that over time, and that time will probably not be very soon, but over time, the assets that we have on our balance sheet from this era will come to maturity, they'll roll off, and the balance sheet will again very gradually return. This will be some years down the road, I would think.
Sorry to interrupt, but I watched how hard it was to get us down from just 4.1 to 3.8 in the latter stages of that, and the consternation it had, both politically and economically. So you're confident that over time we'll be able to manage that size balance sheet?
So what really matters is the size of the balance sheet relative to the size of the economy. And we actually, that came down quite significantly from the end of 2014 until 2017, just by holding the balance sheet constant. So it can be done in a way that is sort of passive and gradual, and it was for about 3 years then. And we came down from, 25% of GDP to 16 or 17% of GDP. So it can be done over time. And in the meantime, I would say it doesn't have implications for inflation. It doesn't have implications particularly for problematic implications. I'm not saying there are no limits to this, but it's not something that raises financial stability or inflation concerns today.